Cameron Mack.
Home, well, millions of other Canadians are having that same thought. And to pay for it, many people take out home equity loans, in total borrowing more than $10 billion a year against the value of their houses. But is that a good idea? Our series on housing continues tonight with our value-added consumer reporter, Jolyn Shane.
So this is our kitchen.
Like the reveal on a home remodeling show.
Well, we had basically a peninsula that came from here and cut off right there.
This 1960s era kitchen was brought into the 2000s. Granite countertops, cork floors, top of the line appliances. At $50,000, the Weens spared little expense. And it was all possible because their house, like so many others in Canada, has soared in value.
We knew we had a lot of equity built in the home because home prices have gone up so much lately. And we'd paid our mortgage down quite a bit. That left us with a fairly large margin of equity in the home.
Look at the math. 10 years ago, they paid $150,000. With $100,000 still left on the mortgage a year and a half ago, they simply added on the cost of the renovations, bringing the debt to $150,000. They could easily handle the payments, but here's the kicker. Thanks to higher housing prices, the home is now worth more than $300,000. So even with the added debt, they still own half their house. So for them, it was a wise financial move.
We were thinking we're adding value, we're not spending money, we're adding to our asset.
And using home equity to make more money, say the experts, is the key to making a good choice.
By adding value to your assets, you would, for example, if you're buying another rental property, the renters end up paying off your new mortgage, so you're growing your assets.
This online bank estimates a third of its new business is homeowners seeking to take equity out of their homes. And many of those people are now using their homes like a bank account.
I knew it would be a difficult sort of road if I went to my bank just because of my income at that time. So I thought borrowing on your house, it would be easier.
And it was. That was the problem.
See, I'm in a good area, so the equity in my house, the price was going up and up from what I bought the house at to what it was, say, at that time. So I just went back and did it again and again.
She bought her house 20 years ago for $120,000. She too renovated for $50,000, and because of property prices, her home is also worth about $300,000. However, she borrowed against the equity several times, sometimes even for living expenses. Now her mortgage is around $290,000. So all these years later, she owns less than 5% of her home.
I guess it's at the point where I could lose my house, which would really, really be an awful thing for me.
Back in Winnipeg, the Weens say they may use their home equity again, but they're also keeping their eyes on the housing market, because if it levels off or drops, using their equity might not seem like such a good idea anymore. Jolyn Shane, CBC News, Winnipeg.
If you have comments about this story or ideas for other consumer items, please send them to valueadded@cbc.ca.
I'm Carolyn Dunn in Calgary. The Alberta economy is booming. The real estate market is skyrocketing. But that's creating a dilemma for some first-time home buyers. How do you get in on the ground floor of the real estate market when prices are becoming so out of reach? That's tomorrow on Canada.
A dream. Just today, news that the average price of a house in this country has hit a record high, and the biggest increase was in Calgary. That's where Carolyn Dunn is tonight with the latest in our series on money and housing.
With his rent and parking about to skyrocket from $975 to $1,500 a month, Steve Page thought purchasing a starter home might be the way to go. That is, until he checked out Calgary real estate prices.
I found that the prices are insanely high and that it's pretty much, even with a good amount of money saved up, that it's an impossibility to get a place unless you run it very close.
Call it the modern first-time homebuyer's dilemma. The more prices rise, the more difficult it is to get into the real estate market. Home buying is just not what it used to be. For decades, there was a standard formula. Save 25% of your down payment, mortgage the rest for 25 years or less. This mortgage broker says in 2007, that's just not realistic.
The mortgage insurance companies have realized that the average middle-class Canadian can no longer afford, a decent house.
To get more people into homes, those old rules are going out the window. Now your minimum down payment can be zero. And that 25-year mortgage, it's so last year. Now you can spread your payments out over 40 years.
And basically, if we put in a 25-year amortization, the monthly mortgage payment is $2,291, okay?
We looked at a $380,000 mortgage with Alexander. With a 40-year mortgage, the monthly payment is $400 less. In the Calgary market, there's good reason to make the numbers work if you can. Last year, prices on average in Calgary went up just over 38%, the biggest increase in the country. And prices are expected to increase again this year.
In terms of average prices, we were talking about the single detached average price going up to $487,500. Well, that'd be about a 38% increase in 2007.
That could leave more potential homeowners out of the market altogether. Remember Steve Page? He's moving home with his parents to save a bit more of a down payment. Carolyn Dunn, CBC News, Calgary.